Good morning, everybody. Good morning, good morning. Thank you for joining us in the research papers room. My name is Dubam, and I'm a second-year MBA student, and I'll get us kicked off this morning. This morning, we have the pleasure of having Dr. Toby Moskowitz present his work, Asset Pricing and Sports Betting. Dr. Toby Moskowitz is the Dean Takashi Professor of Finance at Yale, as well as the principal at AQR Capital. A couple of logistical points before we get Toby up here on stage. We will be having some Q&A. This is a cozy enough room that we will be able to just walk around with mics if you want to ask Toby a question directly. We also will have an online live Q&A platform if you want to ask questions anonymously. You can upvote, and myself and my colleague in the back, Aisha, will be monitoring for the best comments, and I can ask for you. All right, then. Then I guess I'll go ahead and welcome up Dr. Toby Moskowitz.
Thanks, dude. Thanks, everybody, for being here. By the way, it's been 2 years. First conference I've done live in 2 years, so this is really nice. So I'm glad everybody's here in person. Things are starting to look better. This is it's a paper that's going to use sports betting markets, but really to really answer questions in financial economics. So it's sort of more of a finance paper, but certainly the data I'm going to use is sports betting markets. But let me explain what I'm trying to do. This is actually an agenda I've been working on for a couple of years. It's titled Asset Pricing and Sports Betting, which is the first paper I published on this. I'm working on another one that I'm going to spend most of the time on today. But the basic idea is, what can sports betting markets teach us about financial markets? And I'm going to try to draw parallels between these two, because there's a lot of things you can extract from sports betting markets that I think are really interesting, particularly about beliefs and preferences, something that's extremely hard to measure in economics. So as I said, sort of two papers I'm going to talk about. I'm going to summarize the first one, which just got published in the Journal of Finance, and the second one I'm working on, which is really about low risk anomalies. I'm going to explain what all these are in just a second, how they relate to what we see in sports betting markets. But let me start with why I like this laboratory as a cool way to test some of our economic theories. First of all, it's a great, sports betting markets are great because it's an opportunity to see probability in action. So when I teach sports analytics at Yale, we do a whole section on sports betting markets to just extract probabilities and expected outcomes from betting markets, which are great aggregators of information, as long as they're efficient, that is. We'll get to that in a second. Aside from trying to make money, although most often you're going to lose money, the VIG is way too large to make any decent money in sports betting markets. Decent, I mean, millions are fine, but billions you can forget about. Provides an opportunity to also see how markets aggregate that information to make predictions. Now, there's some really strong parallels here to financial markets, right? One of them is this concept of market efficiency. How well does the market aggregate information in an efficient way? It doesn't mean the market's always right. It means it collects the information and makes the best prediction it can based on that information with, of course, a great deal of uncertainty. There's healthy arbitrage activity in these markets. So despite the fact that it's hard to make money because transactions costs are large, there is a healthy arbitrage market of people trying to make money to keep those markets efficient, and some do very well in doing so. It's a direct test, in my opinion, of really interesting behavioral theories, and that's where I'm going to focus on. And what's nice about it is it abstracts from other theories that have been out there. So if you know anything about economics, you know that back in 2013, they awarded the Nobel Prize to Gene Fama and Bob Shiller, my former colleague at Chicago and my current one at Yale, for two diametrically opposed theories about the same set of facts. One being risk-based explanations for what we see in markets, the other being behavioral kind of mispricing, basically people making cognitive errors and that affecting prices in markets. And we can't really figure out who's right, and it's probably a bit of both, to be honest. Sports betting markets kind of abstract from one of those and can focus on the other. They're really about behavioral phenomenon because, let's face it, macroeconomic risk isn't going to explain why different games are priced differently. But I'll get to that in a second. What's interesting, though, is you see some similar patterns or anomalies in sports betting markets that we see in financial markets. My role as a principal at AQR Capital, we spend most of our time thinking about anomalies in financial markets and trying to take the other side of those to make money for our clients. Well, a lot of those same anomalies exist in sports betting markets, which I think is interesting, and we can draw comparisons there and I think learn something. So let me talk about some of those anomalies or those patterns that we see in financial markets, and I'm going to draw some parallels between those and what we see in sports betting markets. First of all, there's something known as the value effect. Okay? And anyone who's been investing in the last couple of years probably knows, Warren Buffett has made this concept famous in practical terms. In academic terms, it was Eugene Fama. But it's very simple. The idea is that cheap assets outperform expensive assets. It seems like a ridiculously simple concept, right? Except remember, in an efficient market, you shouldn't be able to predict anything other than related to its risk, right? That should all be priced in there. Now, how do you define cheap? Well, in financial markets, we would use something like earnings to price or book to price or some notion of fundamental value to market value where a firm looks cheap versus expensive. There's also the momentum effect, which is stuff that's done well relative to other assets continues to do well relative to other assets. It's momentum, okay? You can think of that as it's akin to chasing past performance. Everyone says that's a bad idea, but in securities markets, it actually works. And by the way, it works across all different kinds of asset classes. Value effects, momentum effects, you see them in equities, bonds, commodities, currencies, and even private equity, okay? And so these things sort of play out and seem to be a part of markets. And actually, there's even research that goes back more than a century looking at Victorian age stocks and even the stock market in Imperial Russia. And you find the same effects more than a century ago. So this has always been a part of markets. We don't really understand why. And then there's this third one I'm going to focus on too called the low volatility effect. And this one you're going to see has some parallels too in sports betting markets. Low risk assets outperform high risk assets on a risk adjusted basis. Now, many of our theories in financial markets say it should be the opposite. You should get compensated for bearing high risk, and yet it seems to be perverse. It seems to go the other way, and you see that in bond markets, commodities markets, and options markets, and I'm gonna draw some parallels there today as well. Okay, so all of this sort of says, a simple trading strategy is buy cheap rising stuff that's safe and short the opposite, short expensive, falling and risky assets. Again, it's, and then you neutralize it for other risks in the market, and that's a pretty popular trading strategy, but we don't quite understand why it works, okay? And as I said, there's kind of three schools of thought on this. I've only talked about two. The first is risk, meaning there's some inherent risk underlying these strategies, and when we think about risk in an economic sense, we're thinking about the risk that is tied to your marginal utility of consumption, which sounds, it's very academic. What that really means is when I need the money the most, are these things going to hurt me precisely when I need that money? That's risky to me, okay? Something that's not risky is something that insures me against those states of the world. So when I need to eat, I want an asset that actually offsets my other risks, like my labor income risk. That's a safe security. So think of an insurance contract as being safe and doubling down on the risk in the company you work for as being risky. That's the idea. So risk is one explanation, that although we haven't identified what the risk is, there's inherent risk in these strategies, and it pays off at the worst times, okay? And the risk shows up at the worst times. Then there's behavioral mispricing. Maybe it's just the case that people kind of overvalue expensive stocks and undervalue cheap stocks, or that they overpay for high-risk assets and underpay for low-risk assets. There's a mispricing concept to this tied to cognitive psychology, that people make mistakes when they're evaluating information. In other words, this is a story about markets being not perfectly efficient. And then you have to recognize the third bullet point there, which is all of this stuff could be spurious, right? We're analyzing the same set of data over the same time period. We're going to come up with patterns. That's how you become a famous academic, or that's how you impress your boss at a hedge fund. And we're just mining the hell out of this data, overfitting errors that will have no predictive content, okay? Now, without getting into that debate today, all of these effects that I'm going to talk about today have worked extremely well out of sample, both in other asset classes, other time periods, both going forward in time and backward in time. As I mentioned, the studies in Victorian age England. And so I think the data mining thing has been put to rest, at least on these anomalies, but there's many others that may not be the case. All right. So what's the research question that I'm going to look at here? I want to know, can we distinguish between these theories? Okay? Obviously, if the Nobel Prize Committee gave the award to both camps at the same time, we just concluded they're both great stories, but we really can't tell them apart. Now, why does the explanation matter? You might say, who cares? Well, you do sort of care because financial markets, you care about asset pricing's role in the economy, right? If, for instance, if prices are being distorted by investor behavior, then that's misallocating resources, okay? If it's driven by risk, then that's another source. It creates other allocation issues. And so you care about, prices being correct in the sense that they dictate where resources head, okay? So for those, if you can think of this today, when people are talking about ESG type investing, environmental, socially conscious, and governance type investing, if people care about that, they're going to direct prices. Prices are going to be reflecting that demand and direct resources towards those kinds of technologies and away from, say, polluting technologies, things of that nature. Okay, so you care that markets function well in order to do that. Now, the problem is, in order to distinguish between these theories, financial markets are a particularly challenging laboratory, all right? First of all, you have what's called the joint hypothesis problem, which is any test of whether markets are working efficiently is inherently a test of what you think the right pricing model is. And so you can never tell if markets are functioning poorly, and I had the right model all along, or if it looks like markets are functioning poorly, but I actually just have the wrong model in the back of my mind. And so that's a conundrum that's very, very difficult to resolve. The second thing is, to test a lot of these theories, you really need to get into the inside the heads of investors, okay? For instance, I need to know if people are making mistakes in pricing these, what are their beliefs, okay? Or if it's about risk preferences, what are their preferences for these different investments? And I can't see that in financial markets. I need a model to be able to extract that. I'm going to argue that I think betting markets, sports betting markets, offer us a glimpse at being able to extract that. And one of the things I'm going to look at is being able to extract, or at least distinguish between beliefs versus preferences on some of these things. Okay, so let me start with just why I like this market to sort of help distinguish some of these theories. As I said, there's kind of two main camps for thinking about these patterns in financial markets. Risk-based stories, which are tied to macroeconomic risk, investment risk, consumption risk, there's all different flavors of this. That's not going to apply here in sports betting markets, right? It might apply to the aggregate. What's going on in the macroeconomy, right, might affect the desire to bet on sports in general, but it's not going to affect whether, the Bulls-Raptors game is priced differently than, the Nets-Knicks game, right? That's going to have nothing to do with the macroeconomy. It's just going to have to do with the predicted outcomes of those contests. So if you look at the cross-section of games, you can rule out this whole slew of stories that we've focused on in economics. What that leaves you with are potentially behavioral explanations. And behavioral explanations come from cognitive psychology, which is driven in the lab, in psychology departments, where it's a bunch of undergrads playing for a free pizza, right? It's a bunch of probability games that people play that auto-apply to any context, not just the stock market, but sports betting markets or any risky gamble. So I think it's kind of a nice, out-of-sample test of some of these behavioral theories, and that's the idea here. Now, there's two key features that I'm going to exploit about sports betting markets that allow me to, I think, extract some useful information. One is these are idiosyncratic bets, which is just another way of saying they're not tied to the macroeconomy in any way, the cross-section of games, that is. The second is that if people are making cognitive errors, the beautiful thing about sports betting markets is the contracts are short duration, and there's a terminal payoff that is unaffected by betting behavior. Okay? And so you can actually reveal mispricing. In other words, if bettors are getting it wrong, once the game ends, if we look on average across all the games that end, we know whether prices are systematically biased in one direction or not, because there's going to be predictability in the outcomes, which shouldn't be there. Okay? All right, so I can rule out one set of theories. So here's the data I'm going to try to exploit for the first project that I worked on. I've got data that I'll describe in just a second, which gives me opening and closing prices of the betting contracts. And I'm going to be looking across a bunch of different sports and a bunch of different contracts as well that I'll describe in a second. But you have the opening price, then there's potentially movement in that price before the game starts, which is the close, and then the game ends. Okay, now the price can move for lots of reasons. It can move because there's new information that gets revealed, a key player gets injured, something happens. It can move for sentiment, that bettors just think the price is wrong and they're gonna move the line in one direction or the other, and the bookmakers are gonna try to balance that book. But what's nice about this is the terminal value. You can think of that as the true price, something we never get to see in financial markets, right? There's an end game here where the game ends, the score is revealed, and the contracts pay off. And that true price should be unaffected by people's beliefs or their preferences, okay? I mean, betting behavior shouldn't influence this at all unless you think something like this is going on, right? Which unlikely in today's professional sports, okay? So that's going to be a clean test of whether prices are correct in a sense. All right. So if you think about that, you can actually do some pretty nice tests here to look at efficient pricing versus mispricing and test some of these behavioral theories. For instance, suppose I've got the three prices there, the opening, the close, and then the game outcome. Suppose some positive information comes out. Let's say I'm betting on the home team, and let's say we find out that one of the visiting players gets injured. One of the key visiting players gets injured. Well, let's say that the betting line moves up in the direction of the home team, right? And if it's priced efficiently, then the predictability from the closing price to the game outcome, there should be zero predictability there. In other words, if markets incorporate that information with the right expectations, on average, there will be no predictability for the game outcome, right? You're not going to make money off of that, okay? On the other hand, markets could underreact or overreact to that information. These are kind of two stories that you find in behavioral economics. It could be that markets sort of recognize that this is good news for the home team, but the price doesn't jump up enough, in which case there's predictability. And there's lots of theories why that might be. People are conservative about information updating, all kinds of different theories that come out of psychology. Or it could be the opposite. People overreact to a piece of information, which is, they think it's too good a news for the home team and the price overreacts. Now notice if there's under or overreaction, you get predictability and you can sign that predictability. In an underreaction story, when the price moves, you ought to get consistent predictability in the same direction for the game outcome. If it's an overreaction, you ought to get a reversal, okay? A negative correlation in the return from open to close to end, okay? And of course, you can think of, what if it's total noise? Well, I just think of that as a special case of overreaction. If prices move and there wasn't actually any new information, think of that as a pure overreaction story, right? Because they should have moved not at all, and they moved in some direction. They have to bounce back because the game outcome is not affected by this. Okay, so what I did then is I used this sort of framework, very simple framework, to then test some of the concepts that we see in financial markets like value and momentum, okay? So for instance, if you think about a team that's on a hot streak, right? A team with a lot of momentum, they've won a couple of games, let's say they've beaten the spread over the last couple of games, relative to their opponent, do bettors tend to move the line in the direction of the recent winners and away from the recent losers, and is that direction rational? In other words, does it have zero predictability, so it's efficient, or is there some predictability inherent in that? Okay? So do betting markets sort of incorporate this properly or not? And I'm going to do this by testing this in the NBA, NFL, baseball, and hockey, okay? MLB and NHL as well. Going back to 2005 with one data set. And the other data set, actually I have betting contracts in the NFL going back to 1985. And I'm going to look at three different contracts. The one I have the most data for is just the simple spread contract, which is, and most of you probably know these different contracts, but it's just there's a point spread and you win, you get the same payoff if the favorite wins by at least that many points. If the underdog wins or loses by less than those points, then the contract pays off. Then there's the money line, which is a contract where the payoffs differ. You can bet on the favorite or the underdog. There's no point spread, but the payoffs are different. So you bet on the favorite, you bet $1 to win less than $1. You bet on the underdog, you bet $1, and you end up winning more than $1 if the underdog wins. So in one case, the payoffs and probabilities adjust. That's the money line. In the other case, the spread basically equalizes all that. And then I have the over-under contract, which is just betting on the total number of points scored by both teams. Okay, so it doesn't matter who wins, just what the point total is. All right. The lines, if you're curious, they come from Vegas and the top online bookmakers. I'm going to look at the lines where there's no variation across those, at least for the closing line, which is typically the case. There's a lot of movement before that, but typically things converge. Arbitrage tries to keep those in line. And then I'm going to try to test the following. I'm going to look at, say, momentum, and I'm going to see if teams that are on a hot streak, okay, and you can measure this by winning past wins, you can measure it by beating the spread, you can measure it by point differential, relative to losing teams, Does the line move in either of those directions? Now keep in mind that momentum is a concept at the game level. So a zero momentum game would be one where you have two teams playing each other on a hot streak. There's no difference in momentum there. So the most extreme momentum games are ones where you have a team on a hot streak playing against a team that's on a losing streak, right? That's where you get the biggest spread in momentum, all right? And then I'm going to do the same thing with value effects. Value is this concept of what looks cheap versus expensive. Sports betting markets, you have to think about this a little more. It's a little harder to draw analogies to financial markets, but I'm going to use things like the power ranking of the team based on analytics relative to the contract price, kind of like a book price to market price of the contract, and the difference between those for the teams. And what I find in the data is that there's strong evidence for momentum effects in sports betting markets, but it's an overreaction story. Bettors are chasing recent winners and avoiding recent losers, driving up the line, but that line has negative predictability for the outcome. Okay? In other words, people are there's no, another way of saying this is, there's actually no influence on the outcome of teams on hot versus cold streaks, but betting markets act as if there is one. Okay, so taking the other side of that is a profitable bet. And there's some evidence, more modest evidence of a value effect, that people also tend to like what looks like a cheap contract, a good bet relative to an expensive one, and that gets reversed as well. Okay? Now, I would argue it's clear evidence of mispricing. So here's the summary of the results. The first plot up there is across all sports, and I've got, the spread contract, the money line, the over-under in green, and then a combined, which is a portfolio of all three betting contracts. And you can see the pattern there. This is based on momentum. So bettors are pushing the line up in all three markets, over, under, money line, and the spread contract, and from the open to the close. But then there's negative predictability from the close to the outcome. In other words, they're overreacting to recent performance. Okay? And if I break it down by sport, you see it in the NBA, which is the graph below. And you also see, so it's the same pattern from that overreaction chart that I showed you. And you see it also in the NFL, in baseball, and in hockey. Okay, no spread contracts in hockey or baseball here. All right? And so you see some of these overreaction patterns. So that's the first thing, that you can draw analogies between things like momentum and value effects and in sports betting markets that we also see in financial markets. Now, where I think it can get even more interesting is if you compare contracts on the same game and look at the role of risk versus or preferences versus beliefs. Okay, so in a second paper, kind of related to the same theme, I'm looking at whether I can extract beliefs versus preferences from these betting contracts. This is a really challenging thing to do, but a really important thing to do. Most of our theories of economics and why people choose the things that they do relies on this. You think about insurance choice, portfolio choice, even medical care choice. It comes down to preferences versus beliefs can have a profound effect on what the optimal policies are for individuals. So very difficult to disentangle. What I'm going to do, though, is I'm going to look specifically at this low risk anomaly in financial markets. And remember, that anomaly is low risk assets do better on average than high-risk assets adjusted for the risk. Okay? And that seems the opposite flavor of our classical theories in finance, that high risk should give you better performance on average rather than low risk. It should compensate you. You get the opposite in the data. Now this has a very similar analogy in sports betting, right? You've heard of the favorite long shot bias. There's this known bias in sports betting, although there's some debate about it, by the way, which is that long shots have much lower returns than favorites. Okay? In other words, that betting markets seem to show the same thing. The high-risk asset, the long shot, actually tends to give you bad returns, not good returns. And the low-risk asset, the safer one, the favorite, betting on the favorite, seems to give you higher returns. Very similar to the low-risk anomalies we see in financial markets. Okay? So a low probability with a high payoff seems to be preferred by bettors. It drives the prices high, relative to a high probability with a low payoff. And that's what gives you low returns on the underdog and high returns on the favorite. Now, the leading explanations for this favorite long shot bias are that it's either about preferences, okay, meaning that people just like lottery bets. They like the risk. It's not that they dislike risk. They want the risk. They want that tail event. They want to be able to make a lot of money on a single bet. That's why people participate in lotteries and other things. That's the theory. The other aspect of this, which is hotly debated in this literature, is that it's about beliefs, that people misunderstand how unlikely it is that the underdog wins. They underestimate the probability that the favorite's going to win, and so their expectations are wrong. That's erroneous beliefs. Now, it's really hard to disentangle this. Most of the favorite long shot bias evidence, by the way, is in horse racetrack betting. And then there's some debate you see in other sports like baseball and hockey. You don't see much of a favorite long shot bias. And so this has always been a bit of a puzzle in the literature. People have said maybe it's just not a very robust phenomenon. Okay? But I think I'm going to have something to say about why you see those different outcomes in different sports and for different contracts. Now I'm going to argue that we can exploit something in betting markets that allows us to tell us whether beliefs or preferences are driving this favorite long shot bias or this low risk anomaly. I'm actually going to refer to it as a low risk anomaly instead. And what I'm going to do is I'm going to exploit the difference between the spread contract and the money line contract. Okay? Now just to give you a sense of the difference between these two contracts, for those of you that don't know, it really is going to provide a unique test in this area. They're both bets on the same outcome, who wins the game. Okay? In the spread contract, you have to win by a certain number of points, but those points are set so that roughly the bet pays off about 50-50 on either the favorite or the underdog. The points adjust to make it roughly a 50-50 bet, and you can empirically verify that actually. For moneyline contracts, instead of setting the probabilities equal, they're going to let the probabilities remain what they are. The favorite is a much higher, more likely to win, but you win less money if you bet on the favorite, and you win a lot more if you bet on the underdog. So the underdog is kind of an implicitly levered bet, and the favorite is a delevered bet. Okay? Now, because they're a bet on the same contest with the same outcome, looking at the difference between these two is going to control for anything else that you think might matter. Home team bias, big market bias, anything associated with the team, the matchup, or anything else, it's got to difference out between those two contracts because it's the same game at the same time on the same outcome. All right? And so what I'm going to do is just compare the pricing of these two contracts on the same game, where one is expanding the risk profile of the payoffs, the other is shrinking it to just the identical risk across contracts. Okay, so just to give you a little numerical example here, suppose you have a game where the favorite is a 10.5-point favorite, okay, which is a big favorite, all right? You can see what this might look like. So 10.5-point favorite, I haven't even told you what sport, but pick whatever sport you want. The probability that the favorite wins is essentially 86%, okay, very high probability. If I bet on the money line contract, okay, I bet $1 to win 15 cents. If I bet on the long shot, because there's only a 14% chance that the long shot actually wins this game, I get $5.16 for every dollar I invest. Okay, so you can see the difference in risk profile here between betting on the favorite versus the long shot. That's the money line contract. But for the spread contract, the 10.5-point spread makes it so that the payoff is identical, whether I bet on the favorite or the long shot, and therefore the risk is identical at 50%. So what you have here is the money line gives you an extreme bet. You can either bet on something much more risky or very low risk, and the spread gives you identical risk, essentially a 50-50 proposition. Okay? And I'm going to look at how these things are priced. Okay. So the sports I'm going to use here are same data, but I'm going to be looking at NBA and NFL as well as college basketball and NCAA football as well. So college basketball and football. Now, I've also looked at baseball and hockey. And baseball and hockey, of course, the problem is I have money line, but I don't have a spread contract, so I can't really compare those two. But it's also going to be the case that in baseball and hockey, one of the things that's going to be hard to make this test work is there's not enough spread and risk. But I'll come back to that in just a second. It's one of the reasons I think people haven't found a favorite long shot bias in those sports. But there's plenty of spread, plenty of differences, particularly in college sports, in extreme favorites and extreme underdogs. So you can actually really identify whether there's a preference for risk or beliefs here. Okay? So let me start first with before I get to preferences and beliefs, let me just convince you that risk matters, okay? That the market is pricing the second moment of these contracts in a big way, okay? Not just about expectations, but the risk matters. So I'm going to sort all the contracts in these sports into deciles, going from the biggest underdogs to the biggest favorites. So decile 1 are the 10%. It's betting on the 10% biggest underdogs in all these sports throughout history. And the top 10% are the biggest favorites, okay? And I'm plotting here the money line. This is the standard deviation of returns for betting on the biggest underdogs all the way up to the biggest favorites, using the money line and then using the spread, okay? Now notice if I use the money line, that's the way the contract is designed, betting on the underdog means taking on more risk, and you see that, it's monotonic, okay? And by the way, the standard deviation I calculated here is using actual realized returns if you had bet, but if you just use the ex-ante standard deviation of returns based on the contract prices, it's identical, okay? In other words, markets get this right. So you can see here that the risk decreases monotonically as I go from betting on the underdogs to the favorites. But look at the spread contract. Betting on the underdog versus the favorite, the spread contract nails it, right? There's just zero risk variation across these. Whether I'm betting on the underdog or the favorite doesn't matter because the points adjust and take care of that risk so that it's essentially an equal risk contract, okay? All right. You can see this even a bit more. Standard deviation may not even be the risk that people really care about. What they really like, I think, are tail events. If I look at skewness, you see it even more dramatically. The skewness of the moneyline contract, huge for underdogs and very negative for favorites. And you can see how dramatically, it's monotonic, but look how dramatic the extremes are, right? The 10% biggest underdogs offer you a tremendous amount of positive skewness, okay? And the favorites a tremendous amount of negative skewness. Whereas the spread contract essentially has zero skewness, okay? Has zero skewness by design, and empirically, it has zero skewness as well when you look at the actual data, all right? So now let's take a look at what the returns are, all right? And if you take a look at betting on the 10% underdogs, on average, how well do? You do terrible, okay? In other words, one interpretation of this is the prices for betting on the underdogs and the money line are way too high, okay? You do way worse than you'd expect relative to any other type of bet. The favorite, on the other hand, doesn't do that badly. Keep in mind there's a VIG here, right? A 10% VIG that's hard to overcome. So all the returns are negative on average, but they're far less negative betting on the favorite than they are betting on the underdogs, especially the extreme underdogs. But that's not true for the spread contract. The spread contract, betting on the underdog versus the favorite, there's no statistical difference between those orange bars, okay? So now let's come back to this idea of what's driving the favorite long shot bias. If you think people are making errors in their expectation of the underdog winning, they think that the underdog is going to win more often than is actually true, that should show up in the spread contract as well. It doesn't, okay? So my interpretation of this is there's a strong preference here for skewness. People like the idea of a big positive skew, right? A small probability of a big payoff, and they're willing to overpay for that, okay? You don't get that from the spread contract. But if it was about beliefs, if it was simply about, look, people overestimate the probability that underdogs win, you ought to see that in the spread contract, and you don't. Now, coming back to the literature, this is why I think some people find a favorite long shot bias in certain sports and some don't. If you look at baseball and hockey, for instance, the spread in outcomes, at least the amount of risk that you can bet on, is pretty muted. Okay? You wouldn't expect, according to the theory I'm espousing, if people have a preference for extreme skewness, you're not going to find it in those contracts as easily as you would in, say, college basketball or college football. And I haven't shown you this broken down, but this pricing effect is even bigger in the college sports because you just get a bigger spread in risk exposure that you can get, which makes sense, okay? And you can see here I can easily reject the returns of the same across the moneyline contracts and easily fail to reject that they're any different for the spread returns. Okay, so my interpretation is that markets are predicting the game outcomes very well. Markets are efficient in terms of expectations, okay? In fact, the spread contract seems to be priced extremely well. The difference is that bettors are putting a premium on high volatility assets, okay? Very similar to what we see in financial markets as well. So one way to think about the favorite long shot bias is it's only going to be there when contracts have extreme differences in skewness, right? It suggests a systematic preference for lottery-like payoffs, something that we see in lots of other markets, as I mentioned. But the favorite long shot bias is non-existent when you don't have any difference in risk or skewness, which suggests that beliefs aren't really what's going on here. It's not that investors are getting it wrong. It's just that they have a preference for these low probability, high risk payouts. Okay? Now, are there other alternative explanations? That's the interpretation I'm giving the data. But you always have to consider alternatives. Okay, what's one alternative? Well, maybe these markets are just totally segmented, right? This is a little bit of a cop-out, but you could certainly argue this. Maybe the people that are betting in the money line are just fundamentally different than the people that are betting in the spread contract. I don't believe that's the case. Having talked to professional bettors, I think there's a healthy arbitrage market that works between these. But we can actually test this some ways too. We can actually see if the information you get from the spread contract, does it predict the outcomes from the money line? There's this pricing effect going on that people overpay for high risk assets, but does it predict the game outcomes in the money line just as well? And the answer is yes. Another way of saying this is I get no new information about game outcomes looking at the money line than I do from if I control for the spread. Okay? If I have the spread, that's enough information about game outcomes. The money line gives me no new information about game outcomes. Gives me new information about pricing, but that's about a preference for risk. The other way to look at this too is when the line changes, it changes simultaneously in both of these markets. Okay, so I don't think they're segmented. I think they're quite integrated. So I don't think that's what's going on. A second thing that you could argue is that, and this is a little more subtle, maybe investors get the expectations right for the game outcomes, but maybe they misunderstand the distribution of point spreads, right? In other words, maybe we're pretty good as bettors in aggregate of getting the mean right, but we're not so good at getting the higher moments right, okay? And the money line, which is based off of those higher moments, its payoffs are, maybe it's just harder to price for most bettors, okay? This doesn't seem to be what's going on either. First of all, I can tell you that the point distribution across games is remarkably stable. Okay, so if you look in the NBA, the distribution of points across games is very, very stable. Okay, it's not like certain matchups have a much different point distribution than others. The mean shifts, right, but the distribution looks pretty much the same. So they're relatively constant across games. Another way of saying this is the standard deviation of any matchup in the NBA, the standard deviation of the point distribution of any matchup in the NBA looks pretty much the same across games. Okay, same with the skewness, same with the other higher moments as well. As I mentioned, the spread spans nearly all the variation in win probabilities captured by the money line. And the other thing that you can do too is if you think people are messing up the distribution of points and not the expected outcome, look at the other contract, the over-under. Right? That's a bet on total points, which is about the distribution, about the total points payoff, which is a different expectation than who wins and who loses and by how much. And what you find is those contracts are priced just about perfectly as well. So you'd have to argue that people sort of understand the total points, they understand who's going to win and by how much, but yet they're sort of screwing up these higher moments, even though those higher moments are roughly constant across all these games. It's possible, it just seems unlikely to me. So I'd say that one's unlikely. And then the final one, which is the most difficult one to test, is not erroneous beliefs, but heterogeneous beliefs. Okay, and you might say, well, what's the difference? This sounds like, econo speak, where we're splitting hairs about different theories. Erroneous beliefs means that, we in aggregate kind of get this wrong. We think the underdog is more likely to win than they are, okay? Heterogeneous beliefs means that there's a bunch of us with different opinions, okay? Some of you think the underdog's a lot more likely to win. Some of us think they're a lot less likely to win. And given those heterogeneous beliefs, we're going to naturally sort ourselves into different bets. Okay? So for instance, if Sandy thinks that the underdog is more likely to win than I do, he's going to be much more willing to bet on that extreme money line bet on the underdog. And if I'm more pessimistic about the underdog's chances, I might either take a spread bet or I might even bet on the favorite, right? And so we'll naturally sort into these. And what you might find is that, all that's going on here is people with extreme beliefs are sorting into these extreme contracts, and they're getting priced by those investors rather than the ones that have the median beliefs. Okay? The only problem with that is We actually have betting volume on these contracts as well, and we took a look at where the bulk of the bets occur. So if you think it's extreme beliefs, what would you expect? Well, the people that think that an underdog that has a 10% chance of winning, people who think that they're actually going to win that game ought to be a small portion of the population, right? It can't be an extreme belief if everybody has the belief, right? So if you think about the extremity of these beliefs, but what you find in the data is that betting activity goes in the opposite direction of that. Nearly 44% of bets are on the extreme underdogs. And so that would be sort of a weird thing to think that that significant fraction of the betting population thought that the underdogs were more likely to win. It's hard to rationalize that with a heterogeneous beliefs model. That may be a bit subtle, but let me get back to, so I can't rule it out completely, but it seems less of a convincing story than just a preference for risk. Now, if I take this idea of a preference for risk and I come back to my original thesis, which is, how does this tell us anything about financial markets? Okay? What I can do is do a quantitative comparison. And I'm going to do this in two ways. I'm going to look at the magnitude of this skewness bias, I'll call it, or this preference for risk in betting markets, and see if it can explain some of the things we see in financial markets. I'm going to start by looking at options contracts, and then I can just calibrate a model as well and see how well it explains the data. So let me just first show you this plot here. The orange bar is what you see for the money line contracts, and I've sorted them into bins. The one on the far left is just for underdogs that have, less than a 10% chance of winning the game according to betting markets. And on the far right, it's the ones with a 80 to 90% chance of winning the game. Actually, I think we used 80. I think it was less than 15 and then 85 to 100. We should label that better. And then I've done the same thing for equity index options. This is like options on the S&P 500, where you can look at deep in the money and deep out of the money option contracts. And the idea here is you can look at contracts where the strike price says that there's a 10% chance that you're going to that this option is going to pay off in either direction, whether you're whether you're long a call option, or long the put option, the ability to sell the index. And so what I'm trying to do here is compare apples to apples, which is these are contracts in financial markets that also implicitly, from their prices in financial markets, have a 10% chance of paying off versus a 90% chance of paying off. And I'm going to look at index options in the dark blue, as well as individual equity options in the light blue. These would be options on Apple, Microsoft, individual companies. Okay? And what do you notice here? Well, if you look at the returns, they're pretty similar. In other words, in financial markets too, underdogs or deep out of the money options have very low returns. Okay? That markets are pricing these things, one interpretation, is too high based on standard preferences, or another way to think about it is there's this premium for exposing yourself as an investor to extreme volatility, to extreme positive skewness. You want the small probability of a big payoff. And as you move from the least likely to pay off to the most likely to pay off, the returns get better and better. Okay, so another way to look at this is a famous calculation that's done in financial markets is what's called the implied volatility of options contracts. And the idea here is you take a model that prices options. Some of you may have heard of this, the Black-Scholes model. And you back out what the volatility would have to be to set the prices equal across all these contracts, and then look at that implied volatility. Okay, so another way of, if the prices are off, you could make the prices the same and say, well, what volatility would justify the prices all being the same if I equalized that volatility? Well, we can do the same thing with the money line contract. We could actually assume a very simple, normal distribution. It's probably not totally correct, but it's probably not that far off either. We could back out what the implied volatility or standard deviation of the point outcome would have to be to equalize the prices of the underdog contracts in the money line versus the favorites. Okay? In other words, instead of taking the prices as given, let's use a different volatility for those games to back out what would justify those prices, assuming there were no preference for risk. That's the idea. Okay? And this is what you get. And it looks remarkably similar to what you get in options markets. There's this famous option volatility smile that many people have traded for decades in the options markets. And what it says is deep out of the money options have an implied volatility that's an order of magnitude higher than what you get for options that are priced kind of in the middle at the median outcome. Well, you see the same thing in sports betting contracts. If you back out the implied volatility, you see this volatility smile, and the magnitude is almost the same as what you get in options markets if you're doing it sort of if you scale everything to the same volatility. And that's true in every sport here, NBA, NFL, as well as college football and basketball. So I think that was sort of surprising to us and kind of interesting. Okay, and if you want to see the numbers here, this is what the implied volatility premium is for the 10% winning probability and 90% winning probability betting contracts, and there's what it is for equity options, for call and put options in financial markets. Not exactly the same. You can see that the 10%, the biggest underdogs are, the implied volatility is not quite as extreme as it is in financial markets, but the numbers are certainly in the same ballpark, which is, I think, kind of interesting. Okay, so can we actually do this, though? Link this to financial markets. So I'm sort of pushing this agenda. I get some pushback from my colleagues at Yale and certainly outside of Yale. Can we generalize these results to financial markets? Well, I think there's reasons to be both cautious and optimistic. Okay? On the one hand, you might just say these are totally different markets. The set of people that bet in sports betting markets are totally different than bet on Wall Street, although I spend time in both worlds and I find that they're very similar, and often the same people. People like to the people who like probability and statistics tend to gravitate to both professions. But there's no question these markets are different. You're talking about idiosyncratic bets on short terminal date contracts where you might have different preferences. There's an entertainment value associated with betting in sports. By the way, there also is in the stock market, but it's also, I would say it's secondary in both markets. Most people want to make money rather than lose money. And there's certainly different frictions that pervade in these markets. So on the one hand, you might want to be cautious and say maybe we can't learn that much looking at sports betting markets in terms of financial markets, different preferences, frictions, and they may just be segmented markets. On the optimistic side, which I tend to lean, is I'm looking at the same patterns in both markets, and there's no reason those same patterns should exist if these markets were totally segmented. Secondly, not only do I get the same patterns, the magnitudes are similar, right? If people have a preference for skewness, it ought to be similar in sports betting markets as it is in financial markets because we're all human. If that's something that humans crave, I don't see why that preference would be that different, and at least the numbers I'm getting is that they're not that different. And if I take the numbers, by the way, in sports betting markets and calibrate a model of such preferences, I actually can explain really well what we see in options markets, in financial markets, and even in stock markets for other things that are related to this low risk anomaly, which again did not have to be the case. The other thing I would say is if it's driven by these kinds of behavioral preferences, that ought to be true in any market. So it shouldn't be specific to each of those markets. And then, of course, sports betting markets also share a lot of common features. There's healthy arbitrage. There's analysts, right, who tell you what these contracts should be priced at and who's going to win the game and all that. The goal is to make money. And at least myself, I have a desire for providing a unifying framework that can explain all these facts rather than having a separate theory that explains sports betting markets. It's very different from other financial markets. In fact, in my field in financial economics, we once, it's evolved, but 20 years ago, we had different models for bond markets than we did for stock markets, than we did for commodities, than we did for private equity. And that's changed because as we've pushed for having models that can kind of look at all these asset classes in a unifying way. Now, the features can be different in those markets, but the general principles ought to be about the same. At the end of the day, you're talking about investing, and most investors are invested in lots of these different things simultaneously. So anyway, I'm kind of pushing that as well. So let me stop there, and we've got some time for some questions. But just as a summary here, we find that some of the same patterns like momentum and value show up in both markets. And this favorite long shot bias, I don't really view as a favorite long shot bias. I view it more as a preference for high risk payoffs. Okay, and so similar to what we see in other markets and asset classes. And the punchline is you can't make money off this, by the way. So I saved that to last so that everybody didn't leave the room. But limits to arbitrage, well, that's a good thing in one sense. It allows me to find it in the data. If this were arbitrageable, I wouldn't be able to see it in the data, right? So what keeps markets from correcting this or pricing it differently is that it's very tough to make money. The VIG is just too wide on this, okay? And that may be true in financial markets too, even though the spreads are a lot lower. But that's another issue that I have to think about. So let me stop there and see if there's any questions. Yeah.
Your calculation of the end price after the game display is entirely results-based, or do you factor in like the flow of the game and the win probabilities throughout the game instead of just the final score?
No, I don't even have the data. So the question was, do I have? I'm just looking at the final score for the end price. I don't have within game probabilities. That would be a cool study, though, is to actually see how this evolves during the game as well. There's been some work on that, not necessarily in this direction, but that would be interesting to look at. Yeah, I don't actually have that data. Good question. Other questions? Yeah.
For the momentum effect, what if the line moves in favor of a team that's on a losing streak? Does that make a difference? And the other question I had is, if you systematically just bet on favorites to win but not cover, is that better risk-return profile?
That's two good questions. So I didn't actually dissect. So what I showed is just on average, the line moves in the direction of momentum. But you're right, there are going to be some games where the line moves opposite momentum. That's not the average. That will happen. The problem there, though, is then you have to really track down why it moved, right? If it's for information reasons, right? The quarterback gets hurt, then it's not about momentum. So the hard part, I think, embedded in your question is, are there games where people are betting against momentum and nothing else? And that I don't know. You'd have to try to control for that. But on average, that does not seem to be the case. And then your second question, I haven't analyzed that. I'm not looking at what the optimal return strategy is. I just wanted a clean comparison of favorite versus underdogs. There are certainly better betting strategies than what I've shown you up here. I mean, I told you can't make money off this. And so one could look at that. But if I did, I would want to look at it in the context of what's it doing to the risk profile, and is it consistent with what people are pricing in terms of that risk profile? Okay, that's the thesis I'm interested in. Other questions?
Do you think that the sports side of the analysis that you're doing is, do you think that the sports side of the analysis that you're doing it might be perturbed by the fact that you have a small number of risk takers or layers in the market, whereas in the financial market you've got both people being able to take both sides? And do you think if you looked at the exchange betting markets, that it might give you a slightly different view?
Which betting markets, sorry?
The exchange markets.
Yeah. Oh, so great question. So two things. One is you're hitting on another thing that could be different between betting markets and financial markets, which is the amount of people willing to absorb that risk may be very different, right? Another way of saying this is that the depth of financial markets might be much greater on that dimension, on the risk capacity. I think that's probably right. I would say that it's probably less right when you're talking about individual stock options, which show the same sorts of effects, but still probably generally right. On your second question for the exchange, yes, I actually replicated everything here and using Betfair, and you get the same results, which is really interesting. So it's not about the bookmakers per se. If you look at exchange prices, you get the same effects: strong momentum and very big, low risk effect. In particular. So yes, that's a very good point, though, because how the markets operate, it's really about betting behavior as opposed to who's laying off the risk. Yeah, it's a very good question. Yes.
So in my own personal research, I've been exploring similar comparisons between equity markets and sports betting, more specifically the relationship between credit and debit spreads and, say, like margin betting, like a specific point differential, like a favorite from like 6 to 10, say in the NBA. Mm-hmm. With something like that being far more risky, how do you think your research would extend to the implied volatility of the expected returns there? Because that would be, I guess, extending the extremities of like the money line versus the spread. This would be even more specifically and more fine-tuned.
Yeah, I think that's an interesting idea, which is to look for other strategies that can extend the risk profile and see how they're priced. I mean, another way to do this is look at parlays, right? Which we know are levered bets, right? And they're, people call them sucker bets because the odds are bad for you, but people care about this preference for skewness. It'd be interesting to look at those other bets and see if you get the same magnitudes if you extended that curve out, right? So I think that's interesting. Yeah, send me your paper when you write it up. I'd love to see it. Other questions? Yeah. I'm rewarding people that sit up front, by the way, only because I can't see with it's an old professor trick. Go ahead.
Glad I sat up front today. So I'm curious, so one comment, I will say as a sports bettor, another irrationality in the sports market that you might not get in the financial market is I do something called the Emotional Hedge, where my team, I always bet against my team, which makes absolutely no sense, but I feel like
Makes perfect sense. From a
Right.
financial economist
Right,
perspective,
yeah.
you're hedging your utility.
Right.
It makes
And I
perfect
don't-
sense.
Right, yeah. And so that way, if my team loses, which they typically do, I make the money. So I don't know
Yeah.
if you would get that same thing in the financial markets, which is why the magnitude argument's a little surprising.
You do get that in the financial markets, actually. The best advice I can give people is don't invest in your own company stock, right?
Right.
Yeah, that's call it, it's not even emotional, it's just smart, right? So I think you do see that. We have classic hedging theories for that.
Okay. But my question was, did you see a difference with risk tolerance in regards to the leverage of the game? For example, week 1 of the NFL season versus the Super Bowl. I'm curious if that sort of plays into more or less risk tolerance with the bettors.
So I hadn't thought about it in terms of risk tolerance, which is a really interesting point. So I have not looked at that. We did look at it for momentum. What you find is actually the momentum effect is much stronger early in the season than late at the season. And I think part of it is more of just about uncertainty of information. At the end of the season, I kind of know who the good teams are. Whether they won their last couple of games doesn't affect me much. Beginning of the season, I'm much more uncertain about that. So I'm looking for anything I can that might tell me who's a good team. And you see this every season, right? Everybody was writing off the Chiefs early on and, writing other teams. You see that in betting markets as well. But I haven't looked at this in terms of risk. I hadn't thought about that. I could do that. Yeah, it's a good idea. Other question? All right, we'll go back here. So, the microphone's right there. Yeah.
How sensitive do you think the results are to investor experience? Like if you have a bettor who's making a series of bets and they have reference-dependent utility,
Yeah.
then the risk preferences are going to be super sensitive to where they are located to the reference point.
Yeah, no, that's absolutely right.
So that might explain the preference for the extreme betting.
Yeah, I mean, ideally, if I wanted to test this, like we calibrate a model of cumulative prospect theory preferences, which it sounds like you're familiar with when you mentioned reference points. Unfortunately, I don't have any information about the bettors themselves, right? All I see are prices and aggregate volume. If I had data on individual bettors, so for instance, if I went to like Betfair and got all of their data on who's betting by ID and could look at this, that would be a great thing to look at. It'd be really interesting, right? Because what you're interested in there is, and this relates to the previous question a little bit, which is you can see changes in risk aversion depending on where they've won or lost as the reference point moves. I can only look at this just across games. It's a very limited way of looking at it, but I think that would be a great idea. If that data, if anyone can offer me that data, I'm happy to look at it. So, but that would be cool. Great idea.
You mentioned some puzzles in the stock market.
Mm-hmm.
Did any of this research give you any hints or leanings on those puzzles in the stock market?
Yeah, I mean, I always think of research. I approach things as I actually do classical statistics, but I do approach life as a Bayesian, which is to say that my my update on what's driving these low risk anomalies is that there is a role here for risk preferences. So prior to doing this research, I was probably agnostic as to whether it was beliefs or risk preferences. In fact, one of the leading stories in financial markets is what is leverage aversion, constraints on leverage. That finance theory says you find your optimal portfolio and then you use leverage freely and costlessly to lever up the risk in any way you want. In reality, that doesn't work because leverage costs something and there's all kinds of constraints on it. But I actually think there's just a real preference for lotteries. So my belief in the financial markets anomalies being partly driven by this preference for skewness or lottery-like payoffs has gone up. Now, I think the second, taking that one step further, can I gain any insights looking at the sports betting markets that inform me about that in financial markets? One thing we did, it wasn't related to the low risk anomaly, we're still working on that, but on momentum, is this, I mentioned that early in the season, momentum is a stronger effect than later in the season, because when uncertainty is greater, people kind of anchor to something simple, like past performance. You could look at that in the stock market as well. You can look at firms that just recently announced earnings, where you get a very sharp and informative signal about their value versus firms announce earnings every quarter, so but in different cycles. So you can compare two firms that are otherwise identical, one that announced an earnings last week and one that hasn't announced one for 11 weeks. And what you find is the momentum effect is stronger among the latter firm, the firm where there's more distance between the most recent information and the other. So, I think that's an interesting avenue to go, is to take some insights from the story we're telling in sports betting markets and see if we can apply it in some analogous way to financial markets to improve what we know there. So that's a long-winded answer, but yeah. So thanks. We have time for more? One more?
So one interesting problem that we try and solve in Europe, and I guess you'd have the same problem here, is motivation. As you get into late season, you might have teams that have significantly more to play for in terms of what that win can achieve for them. And on the flip side, you have other tournaments the teams might be involved with that are more important than the one they're playing today. I wonder if you considered that, and if there's any equivalency in the financial market for that.
So what I would say is that's really about information on, so I think betting markets get this right, which is if there's a team that doesn't have a lot to play for, you see the spread adjust. You see the line adjust, even though you might say, the Chiefs should kill the Jaguars this week, but they've already clinched, their position in the playoffs. They're probably not going to put in their starters, or at least not put them in for very long. Betting markets understand this. So I think they get that part right. So I don't think that's affecting any analysis here, although one could do a systematic study of that, for instance. In financial markets, I don't know that there's anything equivalent to that. I mean, I've yet to meet a firm, a hedge fund, or anything else that doesn't want to make money all the time, every time. I'm not sure that's the case, but one could imagine, there's been some work in the literature on mutual funds, for instance, where, if you've had a good first half of the year, you take off risk the second half of the year. You want to preserve the good year because you're evaluated on an annual basis. I think a lot of CIOs tend to do this a little bit as well. Or conversely, if you have a disastrous first half of the year, you'll take maybe some uncharacteristic risks in the second half because you're going to lose your job if you don't. There's a little bit of evidence of that. So, but in terms of like markets understanding this, they seem to understand it pretty well. Yeah. All right, I know we're out of time, so thank you, everybody. So.